Hey everyone, welcome back to my channel. I hope you're all doing well. In today's video, I'm going to give you an update on my Roth IRA account. And I'm going to talk about how my high yield ETF portfolio survived the November beatdown. So I'll talk a little bit about the November dip, and then I'll share some strategies I have for risk management. Okay, so starting off with S&P 500 performance, you can see that this year we had two major dips, one in April and one in November. But of course, April was much more volatile because you can see that it actually dipped under the 125-day moving average. Now, if you look at the fear and greed index, looking at this timeline, you can see that in April and November, pretty bad, so bad it even touched the extreme fear signal. And if we look at the volatility index, you can see that April was pretty bad compared to November. But November was pretty bad for some people who do have positions in high beta names, exposure to the crypto space, and exposure to high yield income ETFs. So your portfolio probably had a little bit of pain because I know mine did. So let's look at my portfolio during November. Now, if you're new here, my high yield income ETF is in my Roth IRA account and it yields just around 25%. Annually, that's about $4,600 in dividends and roughly just shy of about $400 per month. Now, if we look at the portfolio makeup, my core holding is a broad market ETF from Schwab called SCHB. And my two high yield income generating ETFs are WPay and HOOW, and they're both from Round Hill Investments. And the ideal is I try to generate income within the portfolio so I can buy more shares of my SCHB position. Okay, so let's look at HOOW first. This is probably my best investment or company that I've had in my Roth IRA account. You can see that in somewhere between August and September, I buy a lot of shares. And I was just really looking forward to the dividend, but because the underlying stock Robinhood had a pretty bullish run, I mean, the inclusion in the S&P 500 and a lot of positive market sentiment made the underlying stock soar. So it ran up so fast that I decided, well, let me just take some of this profit because it ran up about $4,000. So I thought, oh, that's pretty good. So I didn't get that much dividends. I probably got more in capital appreciation from HOOW. Now, it was actually pretty good that I sold it at this time because you can see that as we head into November, it just sort of waterfalls down all the way to around $48. And when I sold it, it was around 70 bucks. So I'm really happy that I made that sale. Now, after the government shutdown paused, you can see that there's a little bit of a bounce. So I started nibbling on a few shares for HOOW. Okay, so moving on to the next position. This is WPay, sort of a fund of funds. And I bought a lot in October. At this point, this was a relatively new fund. And a lot of people were saying, yeah, WPay should be safer than some of the single ticker ETFs. And maybe so. It just hasn't been out long enough for me to test it. But if you look at this chart, right, I sold some just before mid November, and that was really good timing because right after that, it just sharply declines. And you can see that it hits the bottom just around $44. So it's supposed to be safer, but just looking at this chart, it doesn't seem as predictable as regular cover called ETFs. And because WPay is a fund of funds of leverage ETFs, so it might not be as safe as I thought it would be. But I'm still giving it a try because I still want to collect more data points to make a decision in a few months. But I did buy a few more shares on the way up, so I'm very happy to pick up some shares under $46. Okay, so looking at my next position, again, this is my core position. And I think for high yield income ETFs or portfolio, it's good to have an anchor, something that doesn't move too much with the market. And I think SCHB is a very good candidate for that because you can see here, I bought some in April during the dip. And from that time, the this fund or this position has just kept going up and to the right. So I really like this chart. And you can see that during November, I bought some more. Now, ETH tells a little bit of a different story. There was a lot of hype over Ethereum and, of course, BMNR because of Tom Lee. So I decided to, buy some shares, and you can see that I bought a lot from September to October, and I tried to drip or reinvest the dividends back into the fund, thinking that that would help stabilize the NAV. But it actually didn't. So I sold a little bit in late October, tried to buy a little bit more, but there just was so much negative sentiment. And because of all that liquidation from Bitcoin, I think a lot of it also impacted Ethereum. So we can see here I actually sold out of my entire position, which was actually pretty good timing because you can see that again around November 20th, it just hits the market bottom. Okay, so let's look at my account summary. Overall, I did pretty good. I did take a pretty big beating in November, down $552. It is a lot of money for me, but looking at the other months, I think I did pretty good. And I think when you invest, um, you have to know that you can't always win. There's going to be some losses. Hopefully, you have more wins than losses, and you just have to figure out how to mitigate those losses. So for me, I'm glad I sold those positions when I did. Now, if we look at how I'm doing so far in the last several months, my portfolio is blue, S&P 500 is orange, and Granny Shots is purple. And although I took a pretty big beating in November, my portfolio is overall up this year, and I'm even beating the S&P 500. I'm almost doubling the return. So I'm really happy with what it's been doing in the last few months. Now, if we look at a little bit more details, you can see that my portfolio value towards the end of the month in October hits around $18,497. And that's not including cash, that's just positions. And if we look at the next month in November, it dips to $11,620. And you might be thinking, whoa, you lost $6,876? Man, high yield income ETFs are pretty bad. And I will say they are pretty volatile, but I didn't actually lose that money. I just sold out of those positions and went more into cash. So that 11,000 is still into SCHB um, and a couple of funds that I had throughout November. So you can see that my dividends were about $200 because I didn't have a lot of positions in high yield income ETFs. Now in December, the market starts to do a lot better. Remember, the government shutdown is paused, but it could happen again because of some stuff that's happening in January. So I'm sort of trying to be very cautious about how much I nibble back into the market. Okay, so let's end this video talking about risk management, which is essentially about protecting capital. And I've been in the market for about several years now, and whenever I talk to very successful investors, it's not because they hit home run plays or 10x their portfolio. A lot of times they're successful because they know how to mitigate losses or reduce their losses. So I think it's good to have a risk management routine, especially if you hold high yield income ETFs, because they move different than regular growth funds and other ETFs. Now, for me, when I'm talking about risk management, I'm really specific to a Roth IRA account because there are some things that you can do in a Roth IRA account that are not so easily to be able to do in a taxable account. So, for example, in my Roth IRA account, I don't have to worry about the wash sale rule or about creating a taxable event. It's a lot easier for me to sell a position and then re enter it the next day. Okay, so talking about some strategies, and I think this applies to taxable or non taxable, but just for me, I think if you're in a high beta name or in a high yield income ETF, it's good to have a stop loss order or some kind of sell target. Now, for me, my sell target is about 15%. Less or under the share cost price average. So if I bought something at $40 and it dips $5 under to 35, that's a kind of signal for me to start thinking maybe I need to get out of this position. Okay, now for the stop loss order, some people set some tight stop loss orders like 5%. I find that to be a little bit tricky sometimes because some of these funds have activity in the aftermarket. And because of manipulation or something weird in the market, it might actually dip like by 20% for like 1 second and then rebound. But during that time, you might actually trigger something in your account and accidentally sell your position. So for me, I try to keep it somewhere between 10 and 15% for a little bit lower conviction position. Now, in a really high volatile market, it's also good to reduce leverage positions. And I know it's hard because you might lose some dividends or distributions per month, but in a really bad market where you can't predict what's going to happen in the next few weeks, in my experience, I think it's just good to take some risk off the table and reduce some of the lower conviction, high leverage positions. Now, just one more thing about risk management. I think it's important to not confuse bullish and DCA. I think some people, when they're really bullish on a position or a company, then their strategy is to just DCA and like, take advantage of all the dips. But I think that's very dangerous because you might confuse that with being stubborn and having conviction. Being stubborn, you're just emotionally driven, meaning that, and I've had that same kind of feeling where I've said I have high conviction in this play, but if I sell it, it just means that I didn't have high conviction, and I feel like I would lose face or I don't know what I'm doing. But really, it's your own money, and the only person you should care about is yourself. You shouldn't care about what other people think. So but conviction is something where it's analysis driven from the fact. So, like, I'm really bullish on HOW, but looking at the market, I said, whoa, I cannot predict what's going to happen in the next few weeks. So, I'm going to sell out of my position. And that turned out to be a really good move. Not a lot of skill, a little bit of luck, but always trying to do some kind of risk management in my portfolio. So, have high conviction, but just don't confuse it with being stubborn. Okay, well, that was episode 10 of my Roth IRA update. I just wanted to share this video because I learned a lot in November. I don't always get to test out my risk management strategies because it's not always a down market. This year we've been pretty bullish, but 2026 might tell a different story. I know a lot of people online will say that 2025 was sort of an easy money year, and 2026 is going to be a lot harder. So I think coming from April and November, learning a little bit more about how well my risk management strategies are, I'm going to really need to use that for 2026. So I hope you'll stay tuned and watch more videos on how I, do some risk management in my portfolio. Now for the next video, which is actually going to come out in 2026, sometime in early January, I'm going to do a little recap of my first year in high yield income ETFs and my Roth IRA account. Will I reach 20K in the next 3 weeks? We'll see, right? Well, thank you very much for watching this video and taking time. I hope you have a good week and good luck in the markets. Please like this video and subscribe to watch more free content on achieving financial freedom and living in Asia. And remember, this video is for entertainment purposes only. It is not intended as financial advice. Consult with a qualified financial advisor before making any investment decisions.